Hello everyone, and welcome to our weekly call. I'm Rupert Watson, Head of Asset Allocation. I'm going to start by giving a brief update on the global economy and markets. Niall then will discuss building better prepared portfolios. Simon will discuss the actions companies are taking to reduce or defer cash contributions from their pension schemes. Mark will discuss the impact of the pandemic on the health space. And then Kate will finish up by discussing trends and special considerations for managing your expatriate and cross-border workforce during the current crisis. So turning to the first page, we can see, and I won't go through these because we discussed these last week, that markets have rebounded quite sharply. Equities up a lot, high yield has recovered, although commodities and emerging currencies haven't. So why have markets gone up if we turn to the next page? Because it is perhaps surprising that as we continue to see wretched economic data coming out, global equity markets seem to be strengthening the whole time. And in fact, April will probably go down as the worst single month for the global economy perhaps ever in terms of the growth rate. While in April, the S&P 500 index had its best single month in several decades. And I think the reason why markets have recovered is all down to the Fed. This chart, and indeed other central banks as well, this chart, which goes back to 2007, discusses so-called financial conditions. And essentially it's a measure of how easy it is for businesses, but also for consumers as well, to conduct their business with the support of financial markets. So if in 2008, when you can see financial conditions were exceptionally tight, you as a business, you as a consumer, went to your bank, went to financial markets and said, I'd like to borrow some money because I need to pay a bill, I need to pay my staff, or even I just want to go shopping. The banks and the markets were saying absolutely no way. I remember that in 2007, I applied for an American Express card. I gave Amex no information on me at all. And then when I asked them what credit limit they were giving, they said they'd given me £40,000 credit limit, which was fairly remarkable. And then in 2010, I was speaking to someone who was in quite a high-paid job, and Amex only gave him, I think it was £2,000 credit limit. And so banks have become incredibly wary of lending really to anyone. This time we saw a bit of that at the start of, in March as the crisis developed. But since then we've seen financial conditions ease, we've seen credit markets recover, as the central bank, as the government have thrown huge resources to keep the show on the road and allow businesses and consumers to borrow money with the hope that after the economic downturn, after the lockdown ends, that some degree of normality will be possible later in the year and into next year. They can't stop the downturn we're seeing at the moment, and we've seen some numbers come out of the Bank of England today, their forecast, but they can hopefully help the recovery if and when COVID is under control. I thought if we turn to the next page, I would just quickly comment on Sweden, which is an interesting test case in how to manage the coronavirus. Essentially, there are sort of three sets of countries in the world who have gone about things in a different way. The first is countries like South Korea and Singapore and Hong Kong and Taiwan, who very early on, perhaps because of their experience with SARS, tested like mad and also at the same time did so-called contact tracing, so that if someone is infected, they ask them what they've done over the last few days and then contact those people and tell them they have to self-isolate and they have to test. And with the things like contact tracing apps, you could even work out that perhaps if I've been on a train, who did I sit next to for half an hour? Contact that person, self-isolate, be tested. And so the countries that did that aggressively and early have had a relatively mild outbreak, and both the number of cases and the economic disruption has been relatively modest. In Europe, the US, and other places, they didn't go down that path. and they let the outbreak get out of control, and are now trying to get things back under control, and then they will essentially follow the same model. Sweden is very different because it hasn't imposed any or many of the same containment measures. The chart on the top left is the Oxford University coronavirus response tracker for how strict the measures are. And so you can see Sweden, which is the red line, is much less strict than other countries. And what they've essentially done is banned large gatherings, but have told everybody else to be sensible. So to try to avoid mixing with the vulnerable, to wash their hands, and that sort of thing. And as a result, on the top right, which is a Google report on mobility and how much people are moving around, you can see in Sweden, which is the red line at the top, is that people have reduced their movement, but not by a huge degree. And the lines on the bottom, which are places like Spain and Italy, the UK would be down there, so would the US, have dramatically restricted people's movements. And so it's those countries at the bottom which are going to have the biggest economic downturn. Sweden will obviously have a big economic downturn, but it's not going to be as significant as in other places. The question, of course, is has it worked, or has it led to much more infections in Sweden, many more deaths in Sweden? Of course, the actual confirmed cases numbers are fairly unreliable because in some cases it's a function of how much testing goes on. But you can see with the red line on the left the number of cases in Sweden doesn't seem out of line. If anything is slightly lower than other countries. Whereas the fatalities on the bottom right, which is a number that is quite difficult to, which is an accurate number, in Sweden is somewhat higher than in a country like Germany, but is notably lower than in Italy, in Spain, the UK as well. The time is too early to make a final determination on whether the Swedish way of doing things has been better, but it's an interesting one worth following. And at that point, I'm going to hand over to Niall, but thank you.
Thanks, Rupert. Hi, everybody. If we move forward to the next slide, please. I suppose I think back, I actually joined the first one of these calls, and I remember saying at the time that it was first and foremost a human tragedy. Obviously, since then, the fatalities have massively increased. We're now looking at more than 250,000 of people who have passed away globally from COVID. And so I think it is important to remember at all times this is first and foremost a human tragedy, and there's knock-on consequences for everybody. The circles are coming closer and closer to all of us and all that. And so while I'm going to talk about portfolios and economics, I just recognize in advance this is affecting all of us on the call in various ways. But focusing on portfolios, with that said, when we sat down, this is the slide I actually used back in the middle of March. So we should be focusing on, in our portfolios, how people were reacting, the resilience the portfolios were going to be showing, and the resolution, both the resolution being shown by people managing the money on your behalf, but also what the resolution of the crisis was going to be, and those various things that Rupert talked about a few minutes ago, that people would start looking through what was going on to the future state. And you've clearly seen that in the rally across various asset classes from when we spoke then to now. If we can just go forward one slide. I'm going to focus on a few things. I mean, there's been a lot of things that have gone on in portfolios. We know that the risking that has been done historically and the better diversification portfolios have made a real difference. But I think the key point to remember is that crises like these will occur from time to time. They happened in 08 and 09, and they're happening now. Different reasons, but similar types of drawdown patterns and similar elements of recovery as authorities step in. We have to remember that markets are complex and interconnected and will be volatile. But interestingly, the Chinese character for crisis is actually made up of two symbols. One is representing danger, but the other is opportunity. If we can go to the next slide, there will be situations where there'll be opportunities to take advantage of things. So this is just showing the additional return that can be harvested by lending to high yields, slightly more lower grade borrowers. And what you can see historically, learning the lessons of history, when there's crisis, that spread can become a little bit wider and become a very good time to invest. Historically, we've taken advantage of that, and we've been able to take advantage of that in this crisis as well. When spreads got very, very wide, there was an opportunity to step in. You knew the monetary authorities and the fiscal authorities were going to try and help a lot of companies, and that has been reflected in subsequent pricing. So there is obviously part of the crisis, but part of a robust portfolio is the ability to step into opportunities as and when they arise as well. If we move forward to the next slide, the other thing that's very important is making sure that you can remain nimble. So you have to be able to recognize where conditions are, and if trading is becoming more expensive, you should trade less often. You should take advantage of the fact that if you know at the point at which you're placing a trade, the market has moved significantly in the other direction, maybe you should adjust that. As much as you possibly can, try and net and take advantage of things. And, for certain people in the UK market, they'll be aware of, what people call liability-driven investment, or LDI, and they'll be aware that there's a lot of complexity there in terms of managing collateral. Given the movements that we've seen in assets over the last while, that has been really put to the test, and making sure that you're able to manage that and make a difference there has been really significant. So we have certainly seen that by being smart in doing all these things, we've been able to position our clients to save millions of pounds versus what they would have otherwise occurred by blindly following a strategy. And if we just go to the last slide, I think, there's an important point here. We have hopefully been hearing from clients that it has made a difference to them. And ultimately what we're trying to do is implement things better for clients than they would ever have been able to do that themselves. And you can just see some of the feedback we've had here. But I would encourage, if there's anything that you would like to see more of, if you would say that you'd like to learn more about, please let us know. We talked at the outset, the question function here, either on the meeting or afterwards, but we would love the opportunity to link in and hopefully help people a little bit more. And with that, I will pass on.
Thanks, Niall. It's Simon. If we just move on to the next slide. Thanks. So my name is Simon Turner, and I'm delighted to be here today to talk about what actions we're seeing companies taking to readdress the cash flow requirements from pension schemes in the UK. We're seeing many companies frantically trying to manage cash as they seek to get through the lockdown phase, in the hope that some sort of normality will return in the reasonably near future. To give you some context, in the UK, companies pay £10 billion of cash each year into defined benefit pension schemes. We recognise as a business it's hugely important that pension schemes should be funded appropriately, and deficits in these pension schemes should be managed. However, even more important in a time like this of crisis, we cannot allow and afford for otherwise perfectly sound companies to fail. Our expectation is around 10% of companies across the UK will look to suspend or reduce contributions to defined benefit pension schemes, and this equates to around £1 billion of cash to help with the ongoing cash flow requirements. So at Mercer, we've run 2 surveys that track actions that companies are taking, and a significant number of companies are in financial distress and actually looking at making changes to the amount of cash going into their pension scheme. We surveyed clients in the middle of this process and have found that the clients in the automotive and manufacturing sectors were the most common to have initiated action. But actually, clients across our business and across all sectors in the UK have been affected and have considered this. We found that around 91% of clients who had taken this action had stopped contributions going into their pension schemes rather than reducing contributions. So the slide on the screen is taken from our second survey, and this shows the amount of time which companies and trustees have agreed to stop or reduce contributions. So the headline on this is 43% of companies have suspended contributions for a 3-month period out of the companies we've seen. We believe this is on the back of the pension regulator releasing guidance last month. This guidance allows trustees to agree upon a 3-month suspension or reduction of deficit repair contributions without full information on the employer covenant. 57% of the companies that have done this have suspended contributions for more than 3 months. And this will have required a much more detailed business plan and further information on the economic impact of the coronavirus on the company. So what does this mean for you? I think if your company has immediate cash flow issues, then you should consider or think about suspension or reduction of contributions to defined benefit pension schemes. The longer it takes for normal activity to resume, the greater the collateral damage to the economy will be. However, it is our view it's unlikely a 3-month suspension of contributions will be enough for many companies. We expect many companies to need to go back to trustee boards and require a longer deferral of cash contributions. So in summary, many companies are opening discussions with trustees to stop and reduce contributions to the pension scheme, and we still believe 10% of companies across the UK will do this. It's an unusual situation. However, we face an unprecedented crisis that means we need to come up with new solutions, not simply rely on the old rules of paying £10 billion each year into pension schemes and believing companies can make it through this situation. The pragmatic solution can be agreed between companies and trustees of defined benefit pension schemes, which will hopefully lead to companies surviving coronavirus and members being paid their full pension benefits as and when required. And I'll hand over to the next speaker.
Thanks, Simon. Hello, everyone. My name is Mark Harris, and I'm the consultant team leader for Mercer Marsh Benefits. Could we move to the next slide, please? So I'm in the international team, and Mercer Marsh Benefits, by international, we actually mean expatriate. However, many of the themes I'm touching upon today will apply equally to the UK as well as overseas locations. So I've titled this slide, Access to Care in the Pandemic, as this really from a health perspective is certainly one of the major issues that we're dealing with for employers and employees alike. Access to care is also driving some key long-term consumer health and wellness behavior changes, which will certainly outlast the pandemic. The pandemic has also collided with the recent trend towards the consumerization of healthcare over these last few years. So I'd like to start by outlining more about this trend. So what do we mean by the consumerization of healthcare? Well, really, the consumerization of healthcare is a fundamental shift in individuals' preferences, behaviors, and demands around healthcare services enabled by recent technology developments. So for the first time, patients are transforming from passive recipients of healthcare services to active participants in their own healthcare journeys. If anything, the pandemic we're seeing is accelerating this trend. Clearly, most employees currently are working from home to a greater and lesser extent, country by country, and this does bring its own unique challenges from a health perspective. So what are the key challenges that your employees and dependents face around access to care during this pandemic? We can probably break these issues down into 3 main areas: the sort of access service around care, the planned benefit access due to compliance issues, and the consequent financial impacts to you as an employer. From a service perspective, the access to elective care is probably the main challenge facing everybody at this time. How do you get to a hospital or clinic? Well, the service will have to come to you, and there are new products available in the market to enable this. What about access to care in an emergency situation? So some interesting evacuation repatriation challenges have been brought about due to COVID-19, including the first ever evacuation we've seen from the UK to Germany. Apparently, a German national was struggling to access care in the NHS with suspected COVID-19 symptoms. Many of you know there's a very high bar for admittance to the NHS. So he called his insurer, who then assessed and undertook a repatriation for the individual back to Germany. I think also in general terms, for those of you supporting employees in remote locations, the number of emergency air ambulances equipped to deal with COVID-19 is highly limited, and the cost of evacuations have increased dramatically, of course, due to the assistance company's additional costs. Secondly, there's some broad financial implications from this limited access to care over the coming months. Obviously, with employees unwilling or unable to visit the hospital, insurers are expecting a significant reduction in elective treatment costs in the current period, but with a potential to sort of snap back towards the end of the year. That's assuming lockdown has ended at some stage, of course. One insurer has actually confirmed that claims volumes are down by a staggering 40% this April compared to last April, albeit psychiatric claims are 45% higher than this time last year. Just on that mental health note, I would encourage you all to visit the Mercer Marsh Benefits COVID-19 website. There's some great thought leadership there from colleagues around managing employee mental health at this time. The third area is for those of you managing internationally mobile employees. The issue is around sort of compliance with plan exclusions and admitted insurance regulations in many markets. We've been working with a number of clients whose internationally mobile populations are now effectively stuck in other countries. They might be with relatives or potentially in their holiday homes in other countries. And this brings up multiple challenges from, the existing plan provision. Are there any exclusions for overseas cover or potential local compliance requirement issues which really need to be worked through almost on an employee-by-employee basis? So what are the solutions available to meet these challenges? Primarily the tools and services that have been developed over the last few years to meet the consumerization of healthcare are now available in the market, and as I said, it's a good time from that perspective with regards to the pandemic. Many providers now, for instance, offer access to telehealth solutions, or sometimes called telemedicine solutions. In broad terms, it does what it says on the tin. Employees download an app and book a telehealth consultation with a registered medical practitioner. Many telehealth solutions have e-prescription capabilities, so employees can get their prescriptions through the post. So great service to access care from home. And employee satisfaction actually with telehealth solutions is running at about 98%. And of course, there's a significant reduction in outpatient costs for employers as well, because essentially the consultations are free. We think the pandemic will bring a step change in terms of telehealth usage. The data coming out of Wuhan is that the local telehealth platforms have seen an increase by a factor of 10 in terms of usage. So I think pretty much the same thing is going to be happening here. Some providers are also, for instance, offering healthcare at home solutions, normally limited to big cities. But if you have large population employees matched to provider capabilities, the ability for an employee to have a home visit from GP or physio can, of course, be invaluable at this time. And increasingly, there are other solutions as well, such as DNA testing, offered by some providers through the post, which can help employees on their healthcare journey at this time and actually report on specific DNA, diet, exercise, and stress areas to improve long-term employee healthcare outcomes. So I'm just conscious of time, so to conclude, clearly this is a challenging time for employers and employees alike. However, there are solutions in place to mitigate these challenges, chief amongst them being technology solutions. And if you're fortunate to have an existing telehealth solution in place, please remind your employees to take advantage of this facility. If not, urgently look into potentially placing solutions. That would be a long-term benefit to the employees as consumers of healthcare, and also from a cost perspective for you as an employer. So effectively a win-win. So now I'm going to hand over to Kate on the next slide.
Thank you, Mark. So hello, everybody. Kate Fitzpatrick from Mercer's Career Team. I head up our global mobility practice and have worked quite closely with Mark and his team on all things international.
Apologies for the interruption, everyone. We are just experiencing a momentary delay in today's conference. Just bear with us all.
While there's a delay, this is Rupert here. I will just chat a little bit about the Bank of England report that came out earlier today. This is their regular report. One of the interesting things that came up in it, there are two things I think are worth highlighting. The first is that they expect unemployment to double, or more than double, from 4% previous up to 10%, which is considerably lower than the spike we're going to see in the US, where we get the payroll numbers very soon, and we're going to see the unemployment rate in the US double to 20%. The reason why the UK and indeed most of Europe is going to have less of a pickup in unemployment than in the US is that in the US, companies, the government is supporting employees or supporting households through higher unemployment benefits getting the cash to households that way. Whereas in Europe, there's more of an effort to keep people in jobs and then pay people's wages through the job retention scheme and the like. And so as a result, more people are going to remain in employment in Europe than they do in the US, and hope in the US is that when things start, all the people will be re-employed. Is Kate there?
I am. Apologies, Frank.
Okay, I will stop there. The other interesting point, very briefly, is that the Bank of England, I think, are assuming that by 2023 or 2024, the economy goes back to where it would have been had the shock not happened. Not everyone agrees with that, but I'm going to hand back to Kate.
Thank you very much. Nothing like technology letting us down, so apologies. But yes, Kate Fitzpatrick, and I head up Mercer's Global Mobility team in the career business. And I guess what I wanted to cover off on today is really around focusing on what the priorities for employers have been up until now, what's being done to help manage the packages and the compensation elements of internationally mobile employees, as well as starting to look ahead towards redeployment, return to whatever business as usual is going to look like in the future. So specifically in terms of focusing on priorities to date, the most important thing has really been around tracking all internationally mobile employees. Traditionally, global mobility functions would have focused very much on people on formal assignment types, whereas a lot of the other kind of international travel around business travelers and so forth may or may not have fallen under their remit. And obviously at a time like this, the importance of tracking everybody has really come to the fore, and I expect that as we move forward, we'll see a much greater focus on that awareness and the duty of care associated with that as we move forward. We've also seen a great deal of focus on the special needs and the bespoke types of interventions that have been needed. Mark mentioned in his session there a little earlier just about the individualization of some of the interventions that are being made at the moment, and we've certainly seen that across the board, whether it's with how people have made their decisions to stay put, to repatriate to the home location temporarily, or indeed to a third location, which, as Mark said, has brought up certain compliance issues around health, but also around tax, immigration, and so forth. So, but these have been very personal decisions that individuals have made for them and their families, because again, this is one of those rare topics where we're not just talking about the employee and the impact on them, but it's also their accompanying family members. The other factor that obviously has been very important here is we are talking about the coordination of multiple jurisdictions. So we've seen obviously different things happening at different times in different parts of the world. And coordinating that on a global basis has been a very agile and real-time dynamic kind of situation for global mobility functions to be managing, which has meant their focus on communications and being super flexible and adaptable has really come into play, and in a way that, again, we haven't seen before on a global scale. So most global mobility functions have been extremely stretched at this time. But the priority has been about assigning well-being for them and their families, and really maintaining trust. And you know, on the whole, the corporate world has behaved very well in terms of making sure that people are first and foremost, and their health and safety has been the primary focus, with cost and compliance coming secondarily. Although that's the phase we're in now, is tidying up after that and focusing on assigning packages and costs, really looking into what that impact that's had for the business. In the short term, all of our survey data indicates that for the most part, employees' packages where they're receiving supplementary allowances for being abroad, like cost of living adjustments, hardship allowances and the like, have been maintained with the expectation that any disruption to where people are or the work that they're doing has been temporary. Although we have seen some instances where people have said, okay, do you know what, let's repatriate early, let's bring the assignment to a close. But again, this is very particular to individual circumstances and where they are. But looking ahead, the focus is fast turning to what does it look like to redeploy internationally mobile employees. Obviously, that's going to be very much dictated to by travel and what is and isn't possible. For those who've already been on assignment or are supposed to currently be somewhere, can they return? Can they stay? Can they return home at the end of their assignment? There's a lot of things backed up in the pipeline there in terms of people being able to move about. Again, our survey data indicates that there are still new assignments being planned for later in the year, but all are somewhat on hold, and there's a lot of decisions yet still to be made. But we have also seen a lot more interest in virtual assignments, and by that I mean the sort of work that many of us are doing at the moment, which is actually being based in a location other than the country or the jurisdiction in which the job is being done, but actually operating you know, on a virtual basis. And again, we're expecting to see, this was already a topic when it comes to thinking about working from home and strategic workforce planning in a truly global talent pool. But again, now that we've seen a lot of this being proven to be done, and it's able to be done and able to be done successfully, I expect as we start to plan our way out of this that cadre is going to come into focus as well. So again, conscious of time after my brief interruption there, and so I'm going to hand back over to Rupert.
Well, thank you very much, everyone, for dialing in. I hope you enjoyed that. Please visit our COVID-19 hub page for more information on some and other these topics and others. And I look forward to joining you this time next week. Thank you very much.